Hi everyone. In this video, we will talk about a particular type of grantor retained annuity trust, or GRAT, the Rolling GRAT. We'll talk about what they are, their benefits, and a real-life example. If you still haven't watched our previous video on GRATs, I strongly encourage you to do so. So let's get started. Rolling GRATs are a popular estate planning tool that allows individuals to transfer assets to their beneficiaries without incurring gift or estate taxes. With a rolling GRAT strategy, you are setting up a series of short-term GRATs as a way to minimize the risk of the GRAT strategy and maximize the assets you pass on to your heirs' estate tax-free. One of the main benefits of using rolling GRATs is that the risk of the grantor passing away during the trust term is greatly reduced. This is because if the grantor were to pass away during the term of the trust, the remaining assets would be included in their estate and subject to the estate tax. By establishing a shorter-term trust, the grantor can reduce this risk and ensure that their beneficiaries receive the full benefits of the trust. Additionally, rolling GRATs provide greater liquidity than traditional GRATs. While the trust is operating, the grantor is entitled to a predetermined distribution each year. While liquidity may not always be an issue, it's worth noting that rolling GRATs pay out a greater percentage of assets each year, giving the grantor additional flexibility to decide how to use that money. For example, a 2-year GRAT will distribute around 50% of its assets annually, whereas a 10-year GRAT will distribute around 10%. This means that a series of short-term GRATs will leave the grantor with more assets returning to them annually. Another benefit of rolling GRATs is their potential for increased volatility. The key feature of a GRAT is that the grantor gets to pass on any appreciation above the government's expected growth rate tax-free, whereas anything below that hurdle returns to the grantor. By taking any money that is returned and trying another GRAT, it's advantageous to target maximum asset growth, even if it means huge volatility. In other words, it's better from an estate tax perspective if your assets have a 50% chance of doubling and a 50% chance of staying flat, rather than a 100% chance of growing, say, 10%. With that fact in mind, shorter trust terms, and therefore shorter investment periods, will be better since the returns will be more volatile. For example, and please watch our next video to fully understand the math behind these numbers, if we assume a market rate of return that varies by year, an IRS discount rate of 3%, and an initial funding amount of $24 million, the expected returns after estate taxes in 10 years would be as follows. Option 1, no GRAT. Around $36 million gifted to your heirs, paying around $8 million in estate taxes. Option 2, single 10-year GRAT. $40.7 million for your heirs, paying around $3.3 million in taxes. Option 3, rolling GRATs for 10 years. Almost $44 million for your heirs, entirely estate tax-free while not using all of your lifetime exemption. To see how rolling GRATs work in practice, let's consider the following example. Imagine that a grantor has $10 million in assets that he wants to transfer to their beneficiaries without incurring gift or estate taxes. To do this, the grantor sets up at least one new GRAT per year, each with the same duration. 2 years is standard. He funds the initial GRAT with a portion of their estate, and then takes the annual distributions from that trust and funds 2 additional trusts. Then, the grantor takes the distributions from those trusts to fund additional ones, and so forth. This gives him 2 GRATs operating with the same strategy and timeline, allowing them to maximize the potential growth of their assets and pass on more to his beneficiaries without incurring taxes. Overall, rolling GRATs are a powerful estate planning tool that can help individuals pass on more assets to their beneficiaries without paying gift or estate taxes. By establishing short-term trusts and taking advantage of the potential for increased volatility and liquidity, grantors can maximize the benefits of their GRATs and ensure that their beneficiaries receive the full value of their estate. I really hope you found this video useful. Now, a quick word about Valur. We have built a platform to give everyone access to the tax planning tools of the ultra-rich like Facebook founder Mark Zuckerberg and others. We make it simple and seamless to pick the best strategy, set up and administer these structures at a fraction of the cost of competitors. If you still have any questions, you can visit our website at valur.io. You can read our content on tax planning strategies, play with our online calculator to discover your financial gains by picking different trusts, or schedule a call with us.